Hello, everybody. Welcome to my intermediate accounting video walkthrough. This is for exercise 16-7. This is from the Intermediate Accounting 17th edition textbook. Authors are Don Kiso, Jerry Weingant, and Terry Warfield. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of myself and not the authors of the textbook or Wiley. And myself is Bennett Tchaikovsky, so let's go ahead and get to it. Okay. So when we're looking at exercise 16.7, we've got Elliott has decided to raise additional capital by issuing $170,000 face value of bonds with a coupon rate of 10%. In its discussion with investment bankers, it was determined that to help the sale of the bonds, detachable stock warrants should be issued at the rate of one warrant for each $100 bond sold. The value of the bonds without the warrants is considered to be $136,000, and the value of the warrants in the market is 24. The bonds sold and the marketed issuance for 152. So when you have detachable stock warrants, you're going to assign a separate value to the bond and then to the warrants. The first thing we want to do, though, is let's take a look at the fair market value over here with the bonds and then of the warrants. So the bonds have a fair market value of $136,000. The warrants have a fair market value of $24,000. So when I add these two items up together, it gives me $160,000. The challenge we have, though, is that the proceeds, or basically the cash that I got from the bonds, is $152. So what I have to do is I have to do an allocation between, because the total fair market value is $160, I have to allocate between these two. So what I'm going to do is I'm going to take the bonds divided by the total value, or 136 divided by 160, 24,000 divided by 160. So this is telling me that the warrants in terms of fair value are 15% of the total fair value. So what I'm going to do now is I'm going to take my proceeds. My proceeds were 152,000. And what I'm then going to do is I'm going to multiply that 152 over here to 85 times 152, 15 times 152. So this is going to tell me how much I'm going to be going through and allocating to the warrants and then to the bonds. So whenever I record a bond, and let's go ahead and do this. So right over here, and what date do we do this? No date is indicated. So we would have date. I'm receiving total cash of 152,000. So my bond payable is always going to be shown at face value, or $170,000. For my additional paid-in capital warrant, this is going to be 22,800. The book calls it additional paid-in capital stock warrants. So over here, this is going to be 22,800. And then we get into the discount on the bonds payable. So the discount on bonds payable is going to be 170,000, which is the face value, minus the amount we're assigning to it. So this is 170,000 minus 40,800. And let's just make sure this goes through and adds up, and it does. So this is how we go through and look at this. So again, bond payable, always going to be at the face value. Because the warrants are detachable, we want to assign a separate value to the bonds and then to the warrants. Now, in the second example here, if the warrants were non-detachable, would the entries be different? And the answer to that is yes. If the warrants are not in fact detachable, essentially what you're going to go ahead and do is we're going to take cash we're just going to go ahead and disregard the value of those warrants if they're non-detachable. Okay, so my bond payable is going to be showing here at 170. My cash is at 152. And then my discount on bonds payable is going to be at 18,000. So this is how we go through and handle it if the warrants are non-detachable. So that's how we kind of go through, and the importance of something being detachable is that it can essentially be sold as a separate security. If it's non-detachable, it's really a part of the value of the bond. So you have to buy the bond in order to get to the warrants. So that is exercise 16-7. I want to thank you for watching. I want to thank Wiley. Please don't forget to like and subscribe if you're looking for other solutions. Please feel free to ask me for them in the video comments. Have a great rest of your day.